The markets are rigged. I've gone through this before. I'm going to go into one thing specifically that people will not talk about in the mainstream media, and that is high frequency trading. I'll get into what that is in a moment. Take a look at this. Exchange Head downplays high frequency trading danger. So this guy here, Duffy, who you may know from somewhere else in a previous scandal, is saying that there's no reason to worry. So, for those who don't know, let's get into what high frequency trading actually is. And basically, it's a program trading platform that uses powerful computers to transact a large number of orders at very fast speeds. So then they use complex algorithms and they really dictate what happens. They're able to see and predict, and to use layman's terms here, they have really fast internet connections and they are able to see what you are going to trade when you go for a buy order. You want to purchase that stock at a certain price. They can go into the market, they can purchase that stock, buy it from the market, and sell it back to you at a higher price all before you could even get your order back. This is a total crime. They're using the speed, the technology that they have in order to make money off of everyone, and this makes the market totally contrived. This is a total scam that's been set up, and they are winning big time. Let's go into some of these things right now. High frequency trading. So The Economist is saying this house believes that high frequency trading contributes to the overall quality of the markets. They're saying somehow that an algorithm that is basically much faster, and the speeds and all the technology being used is smarter and faster than humans can be, and somehow that's going to contribute to the quality of the markets. And really what you want are individual investors choosing to put their money in the stock market and have it there for long periods of time. Yet you have high frequency trading that may buy and sell within fractions of a second. How could that possibly improve the conditions in the market? This is fictional, it's a fraud, and it should not be allowed. But the story stays the same every time. Let's go on further. High frequency traders are subpoenaed and sued, and more banking reads. Let's go into what they said here. Basically, that they're going to sue and subpoena uh, these high frequency traders, and they're basically going to have to pay for what they've done. But hasn't the history shown us what happens to individuals when they try to do this, when institutions or individuals try to get back at the banks? Nothing ever happens. And let's say they did have to pay fines. What happens? They get sued for, like, I mean, look at Wells Fargo, for example. They laundered hundreds of billions in drug money, and there's more to that story, but they laundered hundreds of millions and then they paid a small fine. Of course, this is the moral hazard that has been set up where they're allowed to do everything and anything. They sue them with a small little fee and they don't mind paying it because ultimately it's nothing for them. So of course they're going to continue. Let me go on quickly. Barclays and Credit Suisse question in high frequency trading investigation. So here they are getting in trouble in the media. Oh, don't worry, don't look over here. We got it taken care of. Just like all of the things that happened in the bailout. Look what about in the dot-com boom? The same thing. There's always fraud going on, and it continues. Look at this. Goldman Sachs is being investigated for its hiring practice and high-frequency trading. Take a look at those eyes right there. Isn't that telling? This company and all of these big banks never get the investigations real. They're never real investigations. Take a look at what they've done. They're now able to do anything they want in the market. It's all fake. It's all phony. Yet most of the people put their money in what they call, quote unquote, a well diversified portfolio. And what does that include? That includes cash in the bank, and that's some mutual funds, perhaps some bonds, and for the riskier investor, they like to get into stocks. So there you go, a well diversified portfolio, all contrived, all calculated, and manipulated by high frequency trading and other things, which I'll get into in later videos. This is just high frequency trading here. Now, most people would say, look, eventually this is going to have to stop. Look at the insider trading in Congress. They really got to them. That's right. Oh, yes. AP study finds $1.6 billion went to bailed out bank execs. That's what happens to taxpayer money. If you think for a second that they're going to stop these schemes in the paper market, or in any market for that matter, you have something else coming. They are giving billions to themselves. Why? Because they're alumni in the revolving door that this system are basically giving money back to their companies. That's exactly how this works. The whole thing is rigged. Get your money out of the system if you want to survive. That's the only way this is going to happen. If you want more information like this, you need to be an insider. The insiders get the inside scoop. So I hope you'll get on there, and that is at themoneygps.com. At the bottom, you fill in your email address, and you'll get occasional emails from me where I can get into all kinds of things like this. I'll break it down nice and simple, short emails, and I hope you join the others on there.